After scrutinizing AI's impact on markets and competition, let's continue with AI and economic policy. AI offers significant potential to address challenges in monetary and fiscal policy by improving data analysis, enhancing decision making, and increasing efficiency. Alright then, here are some of the key issues AI can address within these policy areas. Economic forecasting and analysis. Accurate economic forecasting is complex and influenced by numerous variables, making it difficult to predict inflation, GDP growth, employment trends, and other economic indicators. AI-powered predictive models and machine learning algorithms can analyze large, diverse datasets, for example, consumer spending, market trends, global economic indicators to improve the accuracy of forecasts. This helps policymakers anticipate economic shifts more effectively and tailor their policy accordingly. Especially with regards to real-time data collection and analysis for policy adjustments, economic policy decisions often rely on lagging indicators, meaning they may not fully capture the current economic situation. What is the solution that AI might be able to provide here? AI processes real-time data from various sources like social media, transaction data, and supply chain activity to provide policymakers with timely insights to economic health. This allows for a more agile policy adjustment approach and responsiveness to economic shocks. Let's be more specific and talk now about central banking, or in the narrow sense, monetary policy. Inflation monitoring and control. The issue at hand might be monitoring inflation trends in real time across different regions and sectors is challenging. AI-driven analytics can monitor prices and inflation indicators with higher frequency and granularity, allowing central banks to respond more precisely and promptly. Real-time tracking and analysis can help central banks fine-tune interest rates. If you think of the Fed, the most commonly known central bank in the world, operates on a dual mandate. On the one hand, it aims for price stability, which was discussed momentarily. That means moderate inflation of 2%. And on the other hand, the goal is maximum employment, which leads us to the labor market insights and policies. The issue at hand: what about understanding labor market shifts and skill demands if it is crucial for effective workplace policy, but traditional analysis is often slow and limited? An AI solution might look as follows. AI can analyze job market data, resume trends and company hiring patterns to identify basically a potential downturn in the economy, and therefore might be able to act with respect to lower interest rates or any other tool at hand. Let's look also at the fiscal side of policy making. Governments might face the following issue: identifying the most impactful areas for government spending, which is often hindered by incomplete or outdated data. AI can analyze spending patterns, economic impacts, and social outcomes to recommend more effective fiscal spending targets. For instance, it can optimize spending on infrastructure, healthcare, and education by predicting the sectors where investments will yield the highest economic and social returns. Managing public debt efficiently requires predicting interest rate changes and economic cycles, which is difficult due to market volatility. AI models can analyze historical data, interest rate trends, and global economic indicators to predict optimal times for debt issuance or refinancing. This helps governments minimize interest payments and manage public debt more effectively. What are other areas AI can be harnessed? Tax evasion and fraud detection. Tax evasion and avoidance reduce government revenue and are difficult to detect with traditional methods. AI and machine learning can detect suspicious patterns in financial data, identifying potential tax evasion and fraud. Predictive algorithms help tax agencies monitor compliance more effectively, boosting revenue and reducing gaps in tax collection. Looking at the fraud aspect of it, fraud and misuse of public funds, for example, social security, unemployment benefits, can lead to significant financial losses. Machine learning algorithms can detect anomalies in spending data, flagging potentially fraudulent claims or transactions. This helps safeguard public funds and improves fiscal accountability. To conclude this lecture, let's look to what extent automated policy simulations can be incorporated into policy making initiatives. The issue at hand, predicting the outcomes of specific policy changes can be challenging and requires complex modeling. AI-driven simulations allow policymakers to test and model potential outcomes of monetary or fiscal policy changes, such as tax adjustments or spending increases, helping them make more informed decisions with fewer unintended consequences. To wrap up this lecture, by leveraging AI in these areas, policymakers can make better informed, data-driven decisions that promote economic stability, improve fiscal efficiency, and enhance the responsiveness of both monetary and fiscal policies.